Hi everybody, my name's Griffin Bridgers. Today I'm going to do a brief blurb on Revenue Ruling 77-402 because it has hidden in it a tax issue that's often overlooked, especially by trust and estates practitioners and even sometimes by corporate and partnership attorneys, and that is the effect of a termination of grantor trust status on a partnership and individual partners, especially when a grantor is the deemed owner of a partnership interest under the grantor trust rules. Now, before we get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, I'm going to overly simplify this, so there's a lot of nuance to this, but there's a certain set of rules within the partnership tax rules that can be a little bit confusing if you've never seen them before, but they harken back to a time when partnerships used accelerated depreciation and non-recourse debt as a way to generate losses in excess of a partner's investment in the partnership, i.e. a tax shelter. We won't go down that rabbit hole in full, but I'm going to highlight some of the rules at the top of the bell curve that you should know. Now, when I say partnership, I'm talking about a tax law partnership. So these are entities usually organized as partnerships or LLCs at the state level, and if they're an LLC, they haven't elected to be taxed as a C or S corporation. So with a tax law partnership, we have pass-through tax rules where each partner proportionally shares in the income, losses, deductions, and credits of the partnership, with some flexibility at the partnership level as to how that sharing can occur as long as there is substantial economic effect. However, when partnership debt is involved, there's some interesting dynamics, especially non-recourse partnership debt. We won't get into the whole nomenclature behind this, but really it involves the inside versus the outside basis of a partner's interest, and basis aside, it involves a situation where a partner's percent ownership interest in a partnership is reduced in full or in part. That could be through a redemption, a sale, liquidation, whatever the case might be. And where we're concerned is that in such a case, the amount of debt relief that's attributable to the reduction in partnership interest is treated as a cash distribution to the partner. So what do I mean? Well, let's take an example. Here we have partner A, and they have a 10% interest in a partnership, and they have zero basis in that partnership interest because of depreciation deductions that have been taken over time. And we're going to assume further that partner A has not personally guaranteed any of the partnership debt. So what is the partnership debt? Well, it's a $1 million mortgage on property held by the partnership, same property that generated the depreciation deductions that A benefited from to recover their basis in the partnership interest. Now, partner A has the partnership liquidate out their interest for $100,000. So that's a cash payment, and due to the zero basis, it looks like on its face, partner A's gain should be $100,000 because they receive $100,000 in exchange for their zero basis. But we can't stop there. We have to look through the partnership to look at partner A's proportionate share of partnership debt that he's being relieved of. And in this case, partner A had a 10% interest in the partnership. The partnership's mortgage is $1 million, so partner A's share of that mortgage is 10% or $100,000, generating an additional $100,000 deemed cash payment to partner A. So in this case, partner A actually has gain of $200,000. Now, this comes up in a sale or exchange of partnership interest under Code Section 741 and 752D. However, there can be an interesting income or outcome where a grantor trust is involved, and that's invoked in Revenue Ruling 77-402. And what happened in this ruling, long story short, is that the IRS concluded that that termination of grantor trust status is a sale or exchange that can invoke those code sections in a case where the grantor trust owns a partnership interest. So what happens is that when grantor trust status is on, you have either the grantor of the trust itself or some other deemed owner, a beneficiary under 678, who is deemed to own for income tax purposes that partnership interest, even though legal title to the partnership interest is held by the trust itself. So the termination of grantor trust turns off that deemed ownership, that tax fiction that causes that grantor or deemed owner to be treated for income tax purposes as the individual owner of that partnership interest. So this turning off, that conversion and termination of that tax fiction is treated under Code Section 77-402 as being the same as a sale or exchange of a partnership interest. So the outcome, as we saw in that revenue ruling and as covered in our example, is that any relief of the grantor's or deemed owner's share of partnership debt that occurs at the time of that termination of grantor trust status will be treated then as a cash payment to that grantor. So if the trust's basis in the partnership interest at the time of conversion is lower than the amount of debt relief, this can trigger gain to the grantor, which can be a bad outcome. So what are our key takeaways here? Well, one, you have to be careful when it comes to the termination of grantor trust status. A lot of people take for granted that unless there is a note involved, there's an assumption that there's no sale or exchange on termination of grantor trust status. But that might not be the case. You have to look through, especially where partnership assets are involved, to make sure that debt relief won't be an issue. So even if you've previously gifted a partnership interest to a grantor trust, or if the note that you use to finance the sale of a partnership interest to a grantor trust has been paid off, you still have to consider this issue. And really where you see this pop up is in older trusts where the trust has held that partnership interest for a while, or where that partnership interest from the outset had a very low basis. Now, I want to note the outcome here may be different if the grantor or other deemed owner remains personally liable for their old deemed share of partnership debt, such as through a personal guarantee. And personal guarantees and such are more common under modern commercial lending standards. So it may be the case that even though the trust itself holds the partnership interest, the grantor may have personally guaranteed that debt, and in that case, we wouldn't have this rule applied. It only applies to the extent there's actual debt relief and relief of personal liability. So where a guarantee is involved, that may not be the case, but you still need to look at the amount guaranteed versus the amount that's deemed to be relieved through that termination of grantor trust status. Now, long story short, even though we have this being an unlikely scenario, apparently under modern commercial lending standards, you can't take this issue for granted. Anytime you have a conversion of a grantor trust to non-grantor trust, look through, see if partnership interests are involved, and anticipate what the amount of debt relief might be to make sure there's no income tax issue that arises with respect to the grantor or beneficiary as deemed owner. If you're a tax or estate planning practitioner and you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com, but with the caveat that I cannot give tax or legal advice in response to your questions. You can also contact me at that same email address if you would like a speaker for your upcoming presentation, whether it's for an estate planning council, CLE program, bar association, or the like. I'm happy to come be a speaker for your upcoming event. But I thank you again for listening to this video, and I look forward to seeing you in my future content.